Hi, I'm Amelia Bordeaux, and I'm here once again with Paul Craig for our latest macro market talk. We still need to think of a name, Paul. But anyway, I'm glad to see you. Paul is the founder of View from the Peak and the US-China series, and I am the founder of Market Compass. So let's jump right in because there's so much going on in the markets. And it started with a wild week this week with Navarro and his comments on the U.S.-China trade deal. So do you want to talk about that since you're the China expert?
Thanks. I'm more of a China expert than Navarro is. Let's put it that way. Look, what do we think of this? Do I think the trade deal is dead? Yes. Bigger picture, do I think U.S.-China relations are going to continue to spiral towards a digital Iron Curtain, new Cold War scenario, which will outlive a Trump administration, and if we have a Biden administration, we'll go into that and morph into different forms? Yeah, we are. Amelia, we're going down that path. Now, did Mr. Navarro sort of exceed his mandate by saying it was dead when he probably shouldn't have? Yeah, sounds that way.
What he said was really clear. And then he said, oh, it was misconstrued, but I don't know how you can misconstrue that.
No, it's dead. And for me, I think that is the October surprise for Trump. Because as we've seen with poll after poll recently, the re-election prospects for President Trump as we stand today are not great. And I think there's 40 million unemployed people that can be the reason for that at the moment. Right. But, I think that, and under that scenario, is he FDR who got re-elected 3 times with double-digit unemployment, or is he Herbert Hoover who got booted out of office when employment went from 4% to 18%, throughout the, from 28 to 32? I think he's more like Hoover, but at the end of the day, the reality is that he's got to find a scapegoat for COVID and for the economy, and it is both China. So my October surprise is that they walk out of the trade deal in October. The reason they do it in October is there's no economic impact until after the election.
Oh, I see. Right.
So, if you look at what Biden's doing currently, there's
and it looks like he's a tough negotiator for the United States into the election.
Yeah, I think it does. It makes him look like the tough guy. He has someone to blame. And at the moment, Biden's running attack ads on Trump in the battleground states saying he's soft on China. Mm-hmm. So how does he get over that? Well, he has to derail the trade deal, but he has to do it in such a way where jobs aren't lost in Wisconsin and Michigan and places like this after it happens. So that means you delay it for as long as you can. You pull out of the deal, you blame China the whole way, but you defer the economic impact till after the election. Really good in theory. I think Pete might have let the cat out of the bag a little bit on that one.
Hard to pull off, though. It sounds like a plan, but very hard to pull off in reality.
Yeah, look, the trade deal itself was, it was a flimsy deal to start with. It doesn't address the issues, frankly, that I don't think will ever be overcome because, the two things that the United States...
Which issues? Do you mean the intellectual property? Or...
Yeah, so much bigger than that, Amelia. It's the fact that these are two, very, very different political and economic models that the US over the last 40 years has tried to change. The US had this belief that you could not have economic prosperity without political freedom, and China has proven that can be the case. And the other thing that the US doubted was that as Bill Clinton said, controlling the internet is like nailing Jell-O to a wall. Well, where it comes to the web, China was able to nail Jell-O to a wall. And look, the issues of intellectual property protection, state involvement. Look, at the end of the day, it boils down to the following: that the US and China have fundamentally different views of the involvement of the state in the economy. I don't see how those bridges are ever. That's a bridge that is just too far to a divide that's just far too far. And the reality is, I can make an argument that when America was at its best, if we want to make America great again, when was it last great? You can make an argument that during the 50s and 60s, during the space race and the infrastructure development that we had, during that period, was we had enormous economic growth.
Economically.
we had enormous economic growth. We had, income inequality was at very, 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 very low levels. We had high taxes. We had high growth. We had infrastructure, and the U.S. government was actively involved in the economy in these public-private partnerships, which, unfortunately, that's been frowned upon now.
Maybe
one can make
not. Well, yes, I agree with you. It's been frowned upon, but it's interesting the whole space cycle, right? With SpaceX and NASA, and then Virgin Galactic and NASA too. But that's kind of like the only sector we've really seen a large private-public.
Yeah, I mean,
one of the most visible, I should say.
Yeah, I mean, for example, why are we leaving 5G, which is hands down the most important infrastructure project for the next 2 decades? Why are we leaving that exclusively up to the private sector?
Yeah.
Right, I don't get that. I just don't get that. And are we completely privatizing the electricity grid? That's heavily regulated and the like. And we wouldn't be privatizing every drop of water in the country and stuff like that. I mean, 5G is, again, the most important infrastructure development we'll have in the next 2 decades, and to leave it completely up to the private sector is put it this way, it's something that's going to be underwhelming in terms of the outcomes. Let's put it that way.
But people would say, well, if you left it entirely up to which isn't what you're arguing, by the way, but I'm just saying, devil's advocate, if you left it entirely up to the government sector, people would be like, oh, it would be so inefficient, and it would be, you don't have the greatest minds working at the government sector only from a pay perspective, because if you believe that you need to hire the best minds and pay them competitively. The public sector can't do that. The private sector can do that. And so, but you're advocating more for a combination of the two.
Why can't we have both? So why does the United States not have a sovereign wealth fund that's investing in technology companies? Mm-hmm. Right? Just because you're a passive investor in a technology company, the reason the United States is in the 5G rollout is going to be 3 years behind China is because America doesn't have the equivalent of Huawei. Right? We don't have a high quality we don't have a single high quality global telecom infrastructure company that can rival Huawei in any way, shape, or form. Mm-hmm. There was a debate whether or not the US government should take a stake in Nokia and Ericsson. Mm-hmm. Right? Well, okay, so we not only have we not built these companies ourselves, which is vital for there's no one can deny that the internet infrastructure is as important as any infrastructure that exists in the United States, and yet we don't have any of the companies that can really mm-hmm. build out that infrastructure. Yeah. And if left, if you don't allow Huawei in the system, and there are many, many reasons why you shouldn't have them in the system, the reality is you're going to be 3 years behind China, which means you're 3 years behind China in regards to autonomous vehicles. You're 3 years, and 5G is a tremendous benefit for AI research and all this stuff. And again, I'm not saying the government should take it over. I mean, there should be a plan for the most important infrastructure projects for the next 2 decades.
Yeah. So just bringing it back to Navarro and Monday night, I was here, it was like maybe 10 o'clock at night or something. I was looking at the equity markets on my phone, and I kept getting all these alerts. And so just bringing it back to the very short-term market reaction for people who trade short-term who might be watching. It still roiled the equity futures market. So it was very negative. And that reminded me back in 2019 when we kind of had all those very bad, all of a sudden trade headlines or tweets that had this, immediate impact, not really lasting, but just a short impact. And so we saw also US dollar strengthen, so we still retain the US dollar for many reasons, but as a safe haven currency in times of these kind of panic headlines or unexpected headline bombs.
And I think you summed it up very well by saying short term, right? So I argue, and people push back on this, but I'm adamant on this, that S&P was up 30% last year. Mm-hmm. We don't care about the deterioration of US-China relations.
Yeah, it just was. There were some times where that was a really rocky ride, but yes, it was.
Yeah, but again, it goes back, and we've talked about this a lot in our last couple of conversations. Yeah. It's all about time frame, right? So if you're a family office that is looking at with a 10-year or generational time frame, mm-hmm. You don't really. Well, sorry. Let me say it somewhat differently. Unless you are a very short-term tactical trader, mm-hmm. all these events are buying opportunities or liquidity events, right?
Right.
But remember, we haven't had the US-China trade dispute was unraveling at a time when the Federal Reserve was quite supportive of markets and now is incredibly supportive of markets.
Right.
So one can make an argument that for all the tape bombs that we get thrown at, such as what's going on with COVID, which is more than tape bomb, but we'll talk about that in a second.
They had a backstop. Yeah, they had a backstop. The market had a backstop that whole time. Yeah.
And it has a bigger backstop now.
Yeah, and a bigger backstop now. That's it's so interesting. So we can talk about COVID, but first, do you think this equity market rally, I think, immediately, we're off today and it's been a choppy market all week. It's chopping around. A lot of that has to do with the outbreak in COVID-19 in certain U.S. states that are getting worse and the hospitalization rates. But do you think that the equity market, these Robinhood traders, that are piling into these zombie companies, that we heard of, we've been hearing about that for the past month. And do you think, though, the overall equity market is longer-term investors who were underinvested and that's where the support's coming from? Or is it a late stage, like everyone's piling in? What do you think?
It's a combination. I wouldn't call it late stage. I would call it frothy.
Okay.
I certainly would call it frothy. Now, again, it goes back to the arguments I've been making for a while about quality versus vulnerable, right? Mm-hmm. So do I think Amazon is frothy? Well, on a, again, defining time frame, on a 6 to 5 year view, 6 month to 5 year view, I don't think Amazon's frothy because it's one of the world's greatest companies and, it's got the growth rates to support valuation, and you can make the same argument for Microsoft and the same arguments for Apple. And, even, I think Mark Zuckerberg is the Antichrist, but you can make the same arguments for Facebook as well, right? Yeah. But where the froth exists, I think, is in cyclicality and in those COVID those sectors that were hurt by COVID.
Sectors and the reopening sectors, kind of.
The reopening sectors are vulnerable, right? Because we can call them COVID winners, COVID losers, or we could call them good business models and bad business models, right? Mm-hmm. Because is AMC movie theater a COVID loser or just a really crappy business model?
Yeah, because as you made the point, our last talk, and I think the talk before, which is a great point you made, that everything's been sped up 5 years. So these companies are just being put out of date sooner. They hung on too long, right? In this.
Yeah, and so, but we risk in this world that we're in, where the frothiness is in, and a company like Macys is a good example, right? So
which just laid off 3,900 people today. They announced,
laid off 3,900 people, but the thing that wasn't noticed, it did a bunch of debt restructuring.
Okay.
And not debt restructuring in a default sort of way, but just issued some new debt, was able to add some additional security in regards to real estate and the like. So, at the end of the day, Macys now has access to about $2.8 billion of liquidity, right? Mm-hmm. And that's, even for a company that has cash burn like Macys, it's, that's a lot of money. Mm-hmm. But does it change the Macys business model?
Right.
Does that money enable Macys to compete with Amazon, Walmart, and to a lesser extent the likes of Target and that sort of thing going forward?
No.
I don't think it does.
No, anecdotally, you can't order something online. I mean, I've tried. You can't order something online off of Macys. It gets here 2 weeks after you order it, even if you pay for expedited shipping. Amazon, it's here same day or 1 day later. It's incredible.
I mean, why doesn't Macys, and Macys obviously has an online strategy that clearly isn't working.
Yeah.
Fire them all and call Shopify. I mean, let's just do that, right? And I look at the oodles of liquidity that are out there, and again, I think the inference is, if you have a frothy market, do you have a correction? Well, you are going to get a correction at some stage because you're going to get a correction in the second half because credit's going to deteriorate. Mm-hmm. COVID, we don't really know about. The economy is completely uncertain in terms of how that's going to reopen. So us trying to predict is very, very difficult. Yeah. But we do, the one thing we do know for certain is that the Fed is going to be there and be very, very supportive. Now, that obviously has impacts on the real economy because hopefully that should cushion the number of defaults, particularly in investment grade companies. Yeah. But what it's going to do is it's going to keep a bunch of zombie companies open. And the irony shouldn't be lost on anyone that the poster child for the new era of zombie company is WeWork. Now, whether or not WeWork stays open, and the irony that it's owned by a Japanese company, given the fact that the Japanese invented the notion of the zombie company, shouldn't be lost. The irony shouldn't be lost on anyone. But, what you have is companies that are being kept afloat that
Right.
effectively have negative equity value
Yeah.
over the long haul, but are being kept afloat because they're able to access liquidity.
Commercial real estate. There isn't I used a WeWork for years in New York City. There isn't one currently where I am in Florida, but I have another similar, co-op working space, and it hasn't reopened because they can't figure out yet how to, social distance in the workspace or whatever, because everyone's working for, it's not like one big company, obviously it's many companies, so they can't agree on a policy to so yeah, and just from a commercial real estate perspective, yeah, WeWork that's tough. Commercial real estate is going to be real tough, and yeah.
But again,
it was like a unicorn, and you just this thing, and I always thought it was ridiculous because they always said they were a tech company, used their app, and nobody ever used the app at WeWork for anything, and they were just a commercial real estate company. But now,
yeah, they're a commercial real estate company that took massive duration mismatching. But look at the end of the day, can WeWork? Will WeWork survive? Well, WeWork won't survive unless it has a parent, i.e., SoftBank, that is going to continue to support the company. Now, I think that SoftBank eventually runs out of patience with this, but it's the notion that the market, if you've got zero rates around the developed world and likely to stay at zero, I would argue for 3 to 5 years to come is my guess. And that's a function of demographics and poor productivity. We were going to zero rates anyway, and COVID fast-tracked it. But under that scenario, if you're prepared to pay a significant spread over zero, which from a nominal standpoint is probably not that much, but I'm sure Macys, even with a defunct business model, will be able to fund at 600 to 800 over. I haven't actually looked at that. It's probably tight. It would be tighter than that. But you can have a bunch of high yield bonds that have very bad business models that can fund it, at 600 to 800 over, and people will jump all over that in a zero interest rate world. And all you're doing is keeping afloat companies that probably long term have negative equity value. Yeah. And again, the Robin Hood effect of what happened with Hertz and the like. I mean, it doesn't. All this stuff doesn't prevent the inevitable. That eventually, if you've got a business model that's structurally flawed, unless you change that business model, particularly in a fast changing world like we're in, eventually your customers will abandon you and you will have negative equity value.
Yeah. It's just incredible. Yeah, it's just incredible. And I do hope the Fed, as the Trump administration pressured the Federal Reserve, to lower rates, and obviously it's interesting now to a little bit see the reverse dynamic, how the Fed, Powell keeps reminding the government, Congress, that we have lending, not spending powers. You need to use your fiscal policies, your fiscal tools to improve and put back to work, and make a bridge for unemployed Americans. So that's interesting, the pressure, how each of them pressure the other, and they'll have to continue to do that in the second half of the year. The Fed will have to continue to pressure if, unemployment,
again,
not coming back up, 40 million anytime soon, but.
No, exactly. We've talked about this. I mean, the Fed has mandate issues that they can't do anything without first loss capital, right? So that's for a start. The big issue, and I think even with the partisanship that we know is going to get worse and worse and worse going into the election, we've got a fiscal cliff of sorts coming up at the end of July with unemployment benefits.
Right.
So what we need to do is obviously we need to extend that, right? Because the market, if the Fed is obviously vitally important, but it's, the Fed by itself is not really the issue. It's the marriage of capital provided. Yeah, well, it's capital provided by Congress that the Fed levers, right? So, if we have a fiscal cliff, i.e. if unemployment, if we have a situation like we had, remember back in 2008 when Paulson tried to get the first TARP deal done and it failed?
Wasn't done, right. That's interesting. Yeah, that was a horrible day. I remember that.
And that was
working at a hedge fund, not yours, a different one, but that was a horrible day in the market.
And again, if you would have something similar to that if this didn't get passed. Now, I think that I'm no fan of Steve Mnuchin. Sorry, I should be clear. When Steve Mnuchin became Treasury Secretary, I was as skeptical as anybody. Mm-hmm. I'm not a fan of Steve Mnuchin. Mm-hmm. I never have been. He's done a really good job. Mm-hmm. He and Powell have worked really well together. I saw like White House note. You know how they release the notes, into the public record, and I think he spoke with Powell every single day in April. So they have seemingly very good communication as recorded by the White House notes. And I think it's very, very clear. The markets would not be where they are today if it wasn't for the relationship between Powell and Mnuchin.
Yeah.
I think they've done an absolutely outstanding job. And I said, look, Powell's up on, for me, Powell has gone to the Mount Rushmore of central bankers.
Yeah, he didn't start too well when he started, but he really, you have to give him credit, he really improved his communication ability, and yeah, he came a long way. So let's talk more about, we obviously saw some big news this week from the states, U.S. states. The focus has been there. The focus has been two places in the market. It's kind of EM, Brazil, Mexico. You know, the spread of COVID there and the high fatality rate there. Also, you've had some clustered outbreaks like in Tokyo again and South Korea. So that kind of internationally was getting attention. And then locally, of course, we have Florida, Arizona, Texas has been in the news quite heavily the past few days, especially, you know, this week with the hospitalization rate. So the reopening had this initial euphoria in the U.S., like awesome, you know, like, and then I'm honestly surprised at how quickly that's turned, meaning both from a health perspective and a little bit, you know, more so from a market perspective. I thought we'd be quote unquote okay through the summer, and then the more traditional flu season in the late fall and winter, we may see the second round, but we're really seeing the second wave starting in certain places right now, and we don't exactly know why. Maybe they're not, maybe it's social distancing, maybe the fact that in these warm states here, like in Florida, people are being inside in the air conditioning more because it's, you know, 100 degrees out every day. So who knows?
Amelia, I think it's much simpler than that. You only have to look at photos of beaches, or, you know, you and I were joking about the Ozarks before.
Yeah.
You know,
Big fan of the Ozarks show, by the way. Yeah.
Exactly. Spoiler alert, everybody. In season 4, everybody's going to die because of the lack of social distancing in the Ozarks.
Yeah.
But if you look at South Beach, if you look at I saw photos of the Outer Banks. I mean, people don't care. They are not taking this seriously.
And that gets to the point that we mentioned earlier. Stuff here in Florida opened kind of like Memorial Day weekend, and that was a big weekend. And now we're coming up to another big holiday weekend in the U.S., which is obviously 4th of July. And so these rising COVID cases are coming, you know, ahead of a big holiday weekend. So the combination isn't good. Yeah. We won't know anything in the data for, you know, a couple, 2 to 3 weeks after the 4th of July holiday, but it's not a good mix. Let's put it that way.
No, I get why people wanted to reopen. I get it completely.
Yeah.
If you would have I've got a 13-year-old in the other room who was so sick of my cooking, I cannot, he can't see straight. I get it. Yeah. I get it completely. But it is undeniable that the U.S. economy was opened up too quickly. It's undeniable. And, you know, states that were very, very confident about the fact that they weren't going to have an issue, they're having issues. And, you only have to look at the chart of European cases versus U.S. cases, and European
New York
cases.
City, even, you know, how New York City was the epicenter here, and they've done a really good job. My friends in New York City, you know, I have a place there. Obviously, I lived there 18 years. I still have my place there, and you know, tough people in New York City, like New Yorkers who'd lived there well over a decade, and, you know, very used to city living, and they were having a very tough time by like day 90 of the lockdown, you know. So
there are undeniable
social and, you know, psychological consequences to the lockdown for sure, but
and look,
they seem to beat it.
Yeah, but the trouble is going forward, and if you look at the 5 things that I think will drive and affect risk in the second half of the year, which is Fed, COVID, restarting the economy, the election, and the deterioration of credit. The COVID situation is the one which is outside of the economy where we simply don't have a clue.
Yeah.
We're going to have to react to data versus try to preempt it, because we just do not know.
Right.
But COVID, which I referred to as a very dark grey swan, the second wave, right? Because we know something, we know how to handle it now.
We know more about it. Yeah.
We know more about it. We can be smarter about policy. But the reality is I can make an argument the cat's out of the bag on the second wave, and I can't see how Houston, for example, where, you know, apparently the ICU beds are 97% full in Houston.
Yeah, they have 8 days. Today they met the initial surge capacity, their baseline like surge capacity in the ICU, and in 8 days they'll exceed even the surge capacity. So the Governor Abbott, governor of Texas today, did announce in four or five counties, I don't remember, where the cases were the highest, into elective surgery, so no more elective surgery, so that they can have more spare beds in the hospitals. But it's not a good situation.
Yeah, I mean,
it's a tough situation, and you hate to see a city go through it. Actually, I'll just tell you, like, side note, little story. Houston was one of the last athletic events I had been to because I'm a marathon runner, and January 19th I ran the Houston Marathon through the whole beautiful city. It's a great city, and yeah, I mean, my other city is New York, and so it's sad to see both of these cities now, you know, New York having been through what it's gone through, and now Houston kind of starting to go through perhaps a little bit of the same thing. So anyway,
right, but again, if you look at it going into risk assets going into the second half of the year with this brewing, yes, the Fed's important, and the Fed will prevent a 10 to 20% rally becoming a 30 to 40% rally. No, sorry, sell-off, I should say. So do we get a 10 to 20% correction if COVID reasserts itself? Absolutely, particularly when you combine that with, you know, credit deterioration in July that we've talked about, immense economic uncertainty that still exists. But look, at the end of the day, there is no reason to own frothy cyclical stocks, Macys, Carnival Cruise Lines, American Airlines.
I mean, obviously people can do better, but when they fall, you know, if there was a substantial second wave nationally, I'm talking, and we do get that, you know, that 10 to 20% decline, but no more because of course the Fed is there, then, you know, people will just buy that, right?
Oh, I think so, and they should buy that because here's the truth in this: COVID will go away, or COVID will be manageable, and the Fed will go away a lot later than what COVID will.
Yeah, right.
And if they're your two offsets, you know, the Fed will eventually win from a pure market perspective.
Yeah.
But look, we need, like, it's clear that we need a tailored response. The blanket response of shutting down airlines, doing this, you know, and the national responses that we had.
But as you know, companies have been self-monitoring. So, you know, Apple shut stores in 11 states, and now we saw yesterday the announcement from Governor Cuomo and the governors of Connecticut and New Jersey that people coming in from these 9 states, of which Florida is one, I know Texas is another one, they're subject into New York region, those states, to a 14-day mandatory quarantine. We don't know how that's going to be monitored, but in any event, that hits the airlines. You know, it's just another nail in the coffin. It's just tough for New York City, and it's, you know, I pick them, right? So just my personal example, and, you know, imagine this extrapolated to thousands of people, right? So I have a place in New York. So now if I want to go to New York, I can't be, I have to be quarantined to go back there. And at the start of all this, back in March, I was in New York for the start of it, and I have like a little condo in Rhode Island, and Rhode Island imposed a quarantine from anybody coming from New York.
That's right.
I couldn't get to my property in Rhode Island. I can't get back from Florida to my property in New York. And when I was in New York and I came to Florida, I talked about this briefly last time, I was on one of the last flights where the National Guard didn't meet you at the airport in Florida if you were arriving from New York. So it's just like getting around the United States is like, to properties I own, is so incredibly difficult. Now I'm not complaining.
Which says you own too much property.
I'm lucky, I'm healthy, everything is completely fine, and I'm not complaining. I'm just saying that if you extrapolate that to thousands of business travelers or people who want to go visit family, or, you know, have something that they need to do in another state, this gets really problematic, and it just puts a damper on the economy, is all I'm saying.
Exactly. And obviously next week we'll have, you know, more data on the economy with the payroll number again, which, you know,
that'll be an exciting day.
That will be an exciting day. This is the stuff you live for.
I know, I love it.
So tell me about the prospects of revisions and the like. We have any clue?
There could be one. It'll be a really exciting report because obviously the May report, which came out in early June, that was a shock. That was the up, you know, 2.5 million, and I think across the board, all Bloomberg consensus of the U.S. economists at the big banks had surveyed like down 7.5 million. So that was like gigantic miss. And also they put the BLS put a technical note in on the classification of certain unemployed workers for the unemployment rate. So it could be as high as 16.3%. So just how people are classified. So I don't know if a big revision is now coming to that month, and then we have to see what the current release is for the actual June numbers. But I think it'll be, it'll be exciting day in the market because we could be in for two shocks, like a revision previously and the shock number this time for the June release. But also, it's heading into a thin liquidity ahead of the holiday weekend, right? So
Yep.
it gets released on Thursday this year. Friday is being observed as a federal holiday for the 4th of July on Saturday. So liquidity is going to be real thin, I would imagine. So it's going to be, if it moves, if it comes in surprisingly, it could be like really ugly, in the first
Either
part
way.
of the morning and Thursday, and then people will be out of the market like by 2 o'clock in the afternoon, most likely away on the holiday.
And I mean, look again, and this is going to for someone who's a data geek like you are. I mean, this is going to come as a bit of a disappointment, but unfortunately, data is going to be the economy. For me, is of all the risk factors that go into driving the equity and credit risk premium going forward, the economy is the one which is the most difficult, and therefore the one that we not ignore per se, but you've got to discount in terms of its predictability, because the volatility amongst any earnings release going forward is going to be so pronounced that there's no point in trying to predict a trend either way. So it's, after, again, one data point doesn't make a trend, but it's very difficult to sit there and extrapolate that the employment data you're going to get in July, in June and July is going to be a continued appreciation versus what we saw in May. So, unfortunately, what you have to do is you can't preempt data, you have to react to data.
Yeah.
And that makes the economy incredibly difficult. And therefore, you've got to focus on the things where we have greater certainty, such as the Fed, such as credit deterioration on the negative side of things. The election is going to become an ever increasing and more dominant part of the of what drives risk assets globally, probably as we get into August and September. And then as for COVID, we have, again, the trends in COVID are clear. Or have been clear. So, when COVID started to roll over, there was clear signs that was the top, and it didn't accelerate. And again, we've got to believe that in the days and weeks ahead, that COVID cases in the United States are going to get worse, because that's where we are. That's the trend we're in at the moment.
Yeah.
And that's much more easy to assess than the trajectory of the economy.
Right. Yeah, and we have those numbers. I mean, we have the COVID number. We can watch them. There's certain, places publicly that track that data. So, no, we can definitely watch that and watch your communities locally to see what's happening. I'm living in a little bit of a hot spot right now, so I can see what's happening. And the other thing, in the second half of the year is, I know you don't like talking about it. I love it, though. Brexit. It's like, I love it. You're like, oh, no more Brexit, Amelia. But in October, is the final kind of EU leaders meeting into the end of the year, where I think things will be decided. So for pound traders, we could see some excitement in October too. So a lot going on.
I think the most exciting thing about Brexit is the fact that Boris hasn't had a haircut in 3 months. And for those of you who have not seen Boris's hair in the last 3 months, that is compulsory internet viewing.
I was in London a few years ago, and I was like walking by 10 Downing Street, just like tourists, like la la la, I'm walking, not to see it. I was like in the area for whatever, and Theresa May came right out, so I got to see her when she was. That's my prime minister spotting story.
She, speaking of people, she had the world's worst job.
She did.
The world's worst job.
She was she had a thankless task. That she had to manage. It was tough. Well, how are things in London? I know you're not there right now, but are they?
No, I'm back in Chicago. So speaking of flights, my flight back to Chicago was straightforward. I mean, the two safest places on earth, Heathrow and O'Hare. But no, London's fine. I mean, London is going to have. It's opening up. London, like any big city, is sick of the lockdown. They need to do something. You're going to look. Every city that's reopened has had some reacceleration of cases. That's going to happen in London as well, and across the UK. Whether or not it happens to the same extent of what we had here is debatable. But you have a political dynamic in the UK as well that is anti-face mask and thinking that face mask is a civil liberties thing and all this sort of stuff. And No, look, I think, again, things are getting better. And, globally, this will, I think we're going to ebb and flow for a while. And when you have US cases go up, markets will go down, and when they peak, markets will continue to rally on the back of Fed liquidity.
Yeah.
And frankly, asset markets be them.
That's the pattern, I should say.
That's the pattern, right? So be it emerging markets, be it other developed markets, be it Asia, wherever, it's going to, the performance of equity and credit markets are going to be driven by COVID cases in the US.
Yeah. And it's interesting you say, the face mask issue. So here, where I am in Florida, it's been a big political issue. Do you wear a face mask? Do you not? It's against civil liberties to make people wear a face mask. And very interestingly enough, it was a very political argument. And just recently with our little we have a mini second wave outbreak here. Not in Florida. Florida has a larger one, but I'm talking about the city I'm in here. It's like a mini one. And anyway, it switched right from political to business. It was like, okay, if you want to come into my business now, you need to have a face mask on because I don't want to have to reclose. And if I have to reclose again, I will lose my business.
Everyone, wear a mask.
Yeah.
Just wear a mask.
Then
as soon as this goes away, the sooner we get back to normal. Thank you.
All right, well, thank you for your time. Yeah.
Are we going to do one? Are we going to do one next? Do we have to think of a name between now and next Thursday?
Yeah, and if anyone,
we probably should.
When we post this, if anyone has suggestions, please let us know. We'll have a little contest. If anyone writes in or something, if we get any that are good, we'll give feedback and we'll consider it.
Perfect. See you next week.
All right, take care. Thanks for your time. Thanks everyone for
Bye.
listening. Bye.